Welcome to the Pro Ticker Deep Dive. So today we're diving straight into Japan's IT services sector.
Right.
We're right on the cusp of the July-September earnings season. It's Q2 for their fiscal year 2025.
Yeah, and this sector, it's usually seen as, well, really steady, reliable growth.
Exactly, but right now, it feels a bit like everyone's holding their breath.
Yeah.
That calm
Yeah.
before a potential storm.
That's a really good way to put it. I mean, this sector has been such a key part of Japan's growth story, really fueled by that big push towards digital transformation, or DX as they call it.
Mhm.
So the big question, the real dilemma for investors right now is that powerful engine finally starting to maybe sputter a little? Or is it just that the market got way too excited and expectations are, well, kind of unrealistic now?
That's exactly what we want to figure out today. Cut through all that noise, get a handle on the balancing act. We need to look at the big picture trends,
Right.
understand where companies are genuinely resilient.
When things might get a bit shaky, maybe unexpectedly volatile for you as an investor. And maybe just to give you the quick version up front, fundamentally, things still look pretty solid. That long-term push for software investment isn't going away.
Right.
But, and this is the big but, market expectations are just sky high. So, most of the good news, probably already baked into the prices.
So muted surprises are the theme.
That's what we're thinking.
Yeah.
You really need to search for those stable, high-quality names. Think Nomura Research Institute, maybe OBC. That's where any potential upside might be hiding.
Okay, let's dig into that macro backdrop first. Because, like you said, on paper, it looks great. That digital transformation momentum, it just keeps rolling.
It really does. Companies aren't just talking the talk, they're putting serious money behind cloud adoption, security upgrades, you name it.
The spending data backs that up.
Oh, absolutely. If you check the Bank of Japan's September Tankan survey, it's pretty clear. Large companies are planning to boost their software investment by over 10% year on year.
Over 10%.
Yeah.
Okay, but is that enough? Enough to keep the market happy, I mean, given how much hype is built in.
Well, that's the million-dollar question, isn't it?
Yeah.
Breaking it down, manufacturing firms are looking at about 10.1% increase, non-manufacturing even higher, 11.1%. So, core stuff like cloud migration, integration, that's definitely secure.
Okay.
But like you said, the market's bar is just set so high now, they expect near perfection, especially from stocks that have already had huge runs.
So it's this weird situation where being successful actually creates the risk. The underlying investment is healthy,
Right.
but investors demand knockout, double-digit growth every single time. There's just no room for error when those earnings reports come out.
Precisely. It's the ultimate paradox of high expectations. Even if companies deliver decent results that look perfectly fine on their own, it could easily trigger that sell the news reaction.
Yeah.
People just take profits if it's not an absolute blowout. So yeah, the mood going into Q2 is definitely cautious. It's almost like a fear of success.
Okay, given that caution, let's pivot to the safer bets. The companies that look more defensive, maybe with less downside risk. We probably have to start with Nomura Research Institute, NRI.
Yeah, NRI is definitely an anchor here. A couple of key reasons. First, they've got really strong ties to big financial clients. That means stable, predictable revenue, even if the wider economy gets choppy.
Okay, financials are steady.
And second, their overseas business is growing nicely. We're actually seeing some hints from results from a global peer recently, suggesting things are going particularly well in Australia. That's a direct tailwind for NRI's operations there.
So what makes NRI so fundamentally defensive? Why the anchor status, even if the whole IT market wobbles? Is there a specific operational thing?
It really comes down to margins and recurring revenue. NRI is consistently pushing its margins up towards that, impressive 20% mark.
20%? Wow.
Yeah, which is way better than most competitors. They've got the efficiency, the contract discipline. They can handle some pressure.
Okay, moving from the big players like NRI to maybe a more niche but super efficient one, OBIC Business Consultant, or OBC. I always think of them as the quiet outperformers, really focused on the SME market, small and medium businesses.
OBC is pretty remarkable, isn't it? I mean, how does a company focusing just on SMEs manage operating profit margins consistently above 45%?
45%, that's incredible.
It's just amazing efficiency, really sticky software maintenance contracts, high margins there. They might not make the big headlines like the giant consulting firms, But that kind of steady growth and killer margin profile makes them a really solid name to hold if things get turbulent elsewhere.
Okay, but if their margins are that high
Mhm.
and the business seems so reliable, what's the catch? Is there a hidden risk? Why isn't the stock price even higher?
Well, the risk, if you can call it that, is probably just scale and maybe visibility. The SME market grows steadily, sure, but it doesn't usually deliver those massive headline-grabbing contracts that get momentum traders really excited.
Mhm.
It's more of a slow and steady compounder, so it can sometimes underwhelm traders looking for that quick, explosive jump.
That makes a lot of sense. Okay, let's step into slightly more uncertain territory now, the stable middle ground.
Okay.
Companies where the basics look okay, but maybe there are some external factors causing concern. First up, SCSK Corporation.
Right, SCSK. Generally known as a reliable operator, decent growth from those DX contracts.
Yeah, pretty steady. What are people expecting for their profits?
Consensus is looking for operating profit right around 21 billion. The caution around SCSK right now isn't really about their own performance.
Oh.
It's more about sentiment being a bit muted because of potential issues with some of their partner companies like Net1. There's some nervousness there that might spill over.
Okay, so guilt by association, maybe?
Kind of. If you look past those partnership worries, SCSK's own fundamentals seem fine, and its valuation looks pretty reasonable compared to some of the really high-flying peers.
Got it. Next in this middle group, we have BiPeru-G, used to be Nithon Unisys, right?
That's the one.
And this one's flagged for maybe a bit of near-term disappointment. Operating profit expected to dip year on year, around 11.7 billion.
Yeah, that expected dip is really down to timing, specifically project cycles. They had some really high margin projects finish up last fiscal year, and those are now rolling off the books.
So a temporary headwind.
Exactly. Creates a bit of pressure in Q2. The longer-term story to watch for BiPeru is their shift towards subscription-based digital services. That's supposed to stabilize things and eventually boost margins again as that recurring revenue builds up.
Okay, makes sense. Now, let's talk about the players facing more direct challenges. Firms really grappling with pricing or sector-specific issues. Trend Micro comes to mind, the big cybersecurity name. They seem to have been struggling a bit lately.
Yeah, Trend Micro's facing a tough combo. First, you've got intense pricing pressure in the cybersecurity market. It's just hyper-competitive.
Always is.
And second, there's been a bit of a slowdown in general enterprise IT spending, and security software often feels that pinch first. So their expected operating profit, maybe around 14.9 billion, is actually lagging behind what analysts were hoping for.
So weak sentiment.
Definitely weak sentiment, but from a technical chart perspective, it's interesting. The stock might find some support down around the 7,000 to 8,000 level.
Oh, really? Why is that?
It seems to be partly fueled by lingering speculation from those acquisition rumors that floated around a few months back. Some people might still be buying on that hope.
Gotcha. Okay, let's look at another interesting one. Otsuka Corporation. They had that huge surge last quarter, right?
Yeah.
Maintenance sales were up, 14% year on year, caused a massive short squeeze.
Right, but that huge spike, very likely a one-off. That's the key thing to remember here.
A one-off. How so?
Well, that growth spurt was probably directly linked to companies scrambling because the Windows 10 support was ending. You had this big forced upgrade and support cycle.
The end-of-life deadline effect.
Exactly. That kind of demand isn't something you can replicate every quarter. So this time around, we should probably expect a much more muted reaction to their results, even if underlying sales are decent. The speculative frenzy has likely fizzled out.
Okay, that context is crucial. Let's shift gears again to the high-growth end of the spectrum. This is where expectations are probably the most demanding. Thinking Shift and Bay Current Consulting. They trade at really premium valuations, right? Which puts enormous pressure on their guidance.
Absolutely enormous pressure. For Shift, focusing on software testing, the nervousness isn't just about market fatigue. Investors are genuinely worried about AI disruption.
How so?
Well, the thinking is, could automation dramatically cut the need for human software testers? Plus, there are some underlying concerns about their current engineer utilization rates. Are they keeping busy enough?
Mm-hmm.
So the pressure is intense. For the stock chart to stay looking positive, technically, they really need to hold above that 11,150 level. It's a key support.
Okay, a lot riding on that number. And what about Bay Current, the consulting firm?
Consulting demand long-term still looks strong for them. That whole DX trend requires consultants, but in the near term. We might see utilization rates soften a bit.
Why is that?
Just clients maybe starting to tighten their belts a little, some cost-cutting measures kicking in. Consulting is often one of the first budgets to get squeezed when there's economic uncertainty.
Right, discretionary spending.
Exactly. So for both Shift and Bay Current, they absolutely have to give strong reassurance about their growth outlook for fiscal 2026 to justify those high valuations. If that guidance sounds even a little bit shaky, expect trouble for the stocks.
Okay, let's try and tie all these different threads together now, synthesize the main opportunities we've talked about.
Sure. The big tailwinds are pretty clear. First, that strong domestic spending on digital transformation is creating reliable demand.
Yeah.
Second, companies like OBC and NRI show that if you focus on recurring revenue, you can get consistent margin growth. That's a real positive.
Yeah.
And then longer term, there's potential upside from AI if companies like Shift and NRI can successfully adapt their services to help clients with automation and analytics.
Right, the if is important there.
Mhm.
Okay, conversely, what are the main risks we need to keep in mind? Besides those sky-high expectations we started with.
Well, there are a couple of macro headwinds. You've got FX swings, currency volatility, and also wage inflation putting pressure on costs here in Japan.
Costs going up.
And then there's the kind of irony of AI disruption. Long term, it's an opportunity, like we said, but short term, it could actually hurt the traditional testing and consulting models, putting pressure on firms like Shift as clients look for cheaper, automated alternatives.
Interesting dynamic. Okay, quickly, before we wrap this up, let's touch on the technical charts for a few key names again. NRI, ticker 4307.
Yeah, the charts show pretty solid institutional support down near 5,500 for NRI.
Okay, SCSK, 907.19.
SCSK looks stuck. It's basically trading sideways in a tight range between roughly 4,200 and 4,400. Needs some kind of news to break out of that.
And Trend Micro, 4704. You mentioned potential support, but also weak sentiment.
Right. Technically, the RSI indicator suggests it's deep in oversold territory near 7,000. That often hints a bounce could happen, even if the fundamentals aren't amazing right now. It's one to watch.
And finally, OBC, 4733, the quiet performer.
OBC's chart looks good, just steadily grinding higher, holding a nice, strong uptrend above 8,500. Very stable looking.
Okay, so wrapping it all up.
Yeah.
The overall feeling for Japan's IT services sector heading into these Q2 earnings, it feels more like a pause than a plunge, right?
I think that's fair. The long-term digital investment story, that's still very much intact.
But for investors right now, the theme seems to be focusing on stability, defending margins, rather than chasing aggressive growth or speculation.
Exactly. And maybe the provocative thought to leave you with is this. Those incredibly high expectations are the biggest risk this quarter. If you're looking for safety, for resilience, you probably want to stick with names like NRI and OBC, consistent margins, recurring revenue. Because yes, corporate software investment is high, but how high does the reported profit need to be when the market is demanding perfection? It's a really tricky, maybe even dangerous balancing act for these companies right now.
A delicate balance indeed. Okay, great insights. See you all in the next ProTicker Deep Dive.